Hardcore Finance Podcast listeners, and welcome to the Hardcore Finance Podcast with Shimon and Alex. Today, we have a very special guest, Ravi Sood, who's a financier who's focused on emerging markets. Mr. Sood was the founder, former CEO of Navina Asset Management, a Toronto-based investment firm that was acquired by a major financial institution. Ravi also serves as the chairman of Galane Gold, Jade Power Trust, and Even Company Incorporated. Previously, Ravi was a director of ICC Labs, which was acquired, and Elgin Mining. And so we're so happy to have Ravi on the podcast. And I'm sure we'll get into gold, store of value, wealth management, gold versus Bitcoin, and lots of other incredible topics. So Ravi, welcome, and tell us a little bit about yourself. How did you get started in gold?
Well, first of all, thanks for having me on, guys. Really looking forward to the discussion. My road to gold is a pretty indirect one and an unusual one. My background, education-wise, is math and computer science. Did a degree at the University of Waterloo, and I entered the workforce in the '90s, which was, of course, the halcyon days of the internet boom. And through a quirk of circumstance, well, a long story unto itself, I ended up in the investment business working at a family office, and not where I thought I would be, but it ended up changing the course of my life. But one memory, or the first memory I could tell you about me with gold, is me sitting in my office and having different gold companies come through our office presenting their investment case, raising money, what have you, and thinking to myself, what on earth are these guys thinking? Do we even use gold for anything anymore? And typically at that stage in the industry, and some truth to it still today, the people involved in it, the entrepreneurs, were older. They weren't the most dynamic presenters, and it was kind of like the tail end of the cycle as well. So it was not people who were inspiring excitement in the industry at all. So I had a very negative first impression on gold for sure. But as I became more involved in the investment industry, running money, running various portfolios, and learning more about macroeconomics, and had a really fantastic opportunity with the firm I was with to work directly with people that, I mean, most of us can only dream about having access to. And I had the great privilege of working directly with them for years. I worked with John Crow, who was the governor of the Bank of Canada for many years, also a senior person in the IMF, and at one point chairman of the board of governors of a board of directors of central bank governors, and played a very senior role there. Also, Paul Volcker, former chairman of the Fed, was on our advisory board. Dr. Sidney Jones, Deputy Secretary, Treasury Department, and Ken Curtis, who was at the time Chief Economist for Goldman Sachs Asia, Vice Chairman of Goldman Sachs. So huge exposure for somebody like me who had what we call more of a technical background in computer science, to get exposure to all these things in all these guys with this great macroeconomic wisdom. And my thinking really changed over time to realize that one, if you're an investor and trying to understand the economy and the business cycle that we're in today, you better spend some time thinking about monetary policy and what's been going on at that level. In particular, what's happened since the financial crisis that kicked off in '07 and in earnest in 2008. It's really been the primary driving factor. And I went from somebody who was completely disinterested in gold and monetary policy, not sure that I could have explained what it was, to but interested in mining from an investor's point of view, and base metals and different metals that I could see the application, the supply-demand imbalance, to in 2007 and 8, starting to get interested in gold in its function as a monetary asset. And then after that, getting very interested in gold and also ultimately Bitcoin and other potential stores of value. And that really became sort of the main investment theme for me personally, and everything I was doing from there on in, to the point where in 2010, I started a company, Galane Gold, with the express intent of becoming a gold producer and creating for myself and by extension all the other investors a great investment vehicle for people to participate in what I thought was a coming huge appreciation in gold price. I think with hindsight, I could say my timing was not perfect. I started that company in 2010. Our first operation was a gold mine that we acquired in Botswana in 2011. Literally within days, so we kicked off operations within days of what was to be the peak in gold price, August 2011. And it was largely moving in a downward direction for the next 5 or 6 years. Very difficult to operate or create shareholder value in that environment, but great way to build a company, a lean and mean, tough company that can stand the test of time. If you can survive that kind of environment where your principal product is going down in price for half a decade, then you're in great shape going forward. And so that's kind of my journey to gold, not exactly a straight line by any means, but really a transformation of my thinking and realization that I got to be thinking about monetary policy, and we all do. Any of us who are interested in markets and trying to understand where the value of assets are going.
Yeah, this is a fascinating topic for me because I just like you, I didn't know anything about gold until in my MBA course. I remember I went to a very, both Alex and I went to a very Keynesian school. It's Kellogg. It's pretty much like in Chicago, our arch rivals were the University of Chicago, and people basically thought, oh, those Milton Friedman people want to like starve the children. We want to like benefit the children by printing money. And so it was very funny because like I had one course, money markets and the Fed, with a guy that was, very senior at the Fed, and another course, international finance or something. And both of them were so negative towards gold, but like things just didn't make sense to me that they said, they were like, yeah, the only thing that causes inflation is inflation expectations. Here's a bunch of charts that show, printing money does not cause inflation. I'm like, okay, but what causes inflation expectations? Like, it's not an answer to saying that what causes inflation. And then through Bitcoin, actually, I went down the gold rabbit hole, and I find it fascinating, especially kind of the historical, store of value properties. Like I heard this thing where like the same quantity of gold kind of bought you the same things throughout history, no matter what governments did. So that was fascinating to me. So I would love to hear first, very quickly, like what is your kind of bullish case for gold? Like, why do you think gold is a good investment? And then maybe as a follow-up, we can dive into comparing, gold to the stock market and maybe to Bitcoin as like different ways to store value. But maybe we can just start with like, what's your bullish case for gold? Like, where do you think it is going and why, given the recent government actions of printing lots of money all over the world?
Sure, and it's very difficult, I think, to have any credibility in assigning some sort of price target to gold. It is, when you're talking about a store of value, we can talk about, here's where it was, here's what's happened since, here's where it should be. But the fact is, gold, if I compare it to something like copper, two factors which generally dictate the supply of a good, the supply and demand, that doesn't really come into play the same way on gold, does it? So if I use copper as an example, and apologies for the circuitous answer to a simple question that you've posed, but if the price of copper is dropping below the cost of production of copper, the marginal cost, production will come offline. And we need copper for things. We need it for wires, for pipes, various products that are made. You need copper, period. And the demand for copper goes up and down based on an economic cycle, based on the intensivity of different things that are being built in that cycle. Supply goes up and down based on that price and based on production coming on and offline around the world. For gold, you can kind of throw most of that out of the window. It's almost the only thing in the world because if you look at the amount that's produced, depending on the year and where we are in history, it's 1 or 2% of the total supply of gold that's above ground is being added to supply every year. So if you produced none of it, or you produced twice as much in a given year, of course it will have an effect at the margin, but it's not going to be the primary determinant of the price. Similarly, on demand, Yeah, there are some applications that you need gold for. And in fact, with my mining company, we have 3 operations. One of them sells all of our gold production to Samsung, which use it. We don't know exactly what they use it for, but we can presume that's none of our business, but we could presume it's used in their cell phone business, in their consumer electronics business. But that's a very small part of the gold market, and probably always will be. So unlike copper, throw that out the window. So for me, my focus on trying to come up with the investment case for gold and work around that and develop a business around that is really directional. And I can tell you this, if you are in a bear market for gold, you're going to be very hard pressed to create value for shareholders and make money for yourself in the gold business, like anything else, but perhaps more so for gold. And the inverse is true as well, of course. So if gold's moving up, not to disparage my own efforts or those of my team, but a monkey at a typewriter could figure out how to make money in the gold business in a rapidly rising market. So the focus for me is to figure out what's that direction, and what's the what's the angle of ascent or descent. And for me, that arrow is definitely pointed upwards for gold. And it's back to this monetary look at what's happening in the monetary base and how we've sort of patched over the issues that really came to a head in 2007 and exploded in 2008. They were never fixed. Sure, banks improved their balance sheets and their reserve process. Some of the more problematic practices were curtailed and legislated. But all those issues are still there, and we really floated our global economic boat with huge injections of capital, really borrowing from the future to stabilize things today. The theory on monetary policy is we can smooth over a business cycle by doing such things. That's always been the theory. In practice, has it really succeeded? Perhaps the pessimist, such as myself, would say it succeeded in doing one thing, which is actually increasing the amplitude of the business cycle as opposed to smoothing it over. And I think that's definitely going to be the case this time around. What we'll see only years from now, when the dust is settled, if it settles, that we've held it together, kept the ship afloat for as long as possible using all this bag of tricks that the central bankers have invented, but at a huge cost. And that cost will be borne by people in the form of inflation. And as an investor and somebody trying to not only protect their assets, but in fact create profits and increase the value of my company and the value of my shares, we think that gold is one place that we can be, where you will go from a place right now where it's almost laughed at. I'd say the more educated and more conventionally intellectual one is now, the more you're going to hate gold. I mean, it's very, it's certainly in vogue.
Hey, Ravi, I think we got you on mute by accident.
Yeah, we lost you, and now you're on mute.
So coming from that position, I come to that conclusion that the arrow is pointed upwards and that the angle of ascent is going to be steep. And if you put a gun to my head and say, okay, Ravi, you got to give us some numbers and price targets on it, I'll go back to the same approach that others who try and understand and prognosticate about the price of gold and point to where was it last time where it overshot and we had something that resembled this kind of scenario. That was blow off top in 1980, $800 on gold. You can inflation adjust that a couple different ways. You use the official inflation statistics, and it can give you different numbers, but that'll put you something into the high 2000s as a theoretical blow off top price on gold on this cycle. I think that's probably two observations on that. One is those official statistics are not very representative of actual inflation over that 41-year time period. And second, it's a moving target. As we know, inflation is happening now and it's accelerating. So if that model punches at $2,700, $2,800 gold, that number is going up as we speak, as that inflation number kicks in. The other way to look at it is broad money supply. And if I look at growth in M2 from 1980 till today, and apply that to that blow off top number of $800 41 years ago, you're going to get something over $10,000. And that number is moving, that is a moving per ounce. That number is moving even faster, obviously, than the official inflation statistic. Is either of them a particularly accurate way to predict the potential peak price in gold? I don't think so. But again, it goes to my view is you got to figure out the direction, and the direction is up, and it should be much higher, i.e. a steep angle of ascent on the gold price.
Yeah, that's very cool. And so, yeah, we've been talking a lot on this podcast about like the implications of all the money printing. So I totally get those price targets. Now, one very interesting thing that I've never been able to get like one answer from everybody, like everybody has a different angle to this question. So would love to hear your take on it. So usually when people think of inflation protection, like when you think of normal people, not investors, right? There's two things. There's like real estate and the stock market. So the idea is like with real estate, you're leveraged like 5-to-1. So, if you kind of look at like the way that your down payment value grows over time, that's what most people use for inflation protection if they don't know anything about finance. And stocks too, right? So like people put money on their 401k, and then the idea is like, yeah, the government can print more money, but that means that the companies will have a higher pricing power, and so the value of the equity will go up. So what do you think of gold versus real estate versus the stock market? Like, do you see it as like the same type of inflation protection? Do you think gold has advantages over these two assets, or like how should people think about allocating their capital among those three?
I think you've ultimately, what are you trying to figure out? You're trying to figure out how to protect and ultimately grow your wealth. So I don't think one should be obsessing over one sector or the other. You have to ask exactly the question that you've posed. Should I have money in all these sectors? None of them, only one of them, and how much? And if I break it down to looking at all three of those, as you said, they are an opportunity to hedge against inflation. Your company profits, in theory, should go up. Some will be better positioned than others. I know, for example, one of the safest things that you can invest in, the utility business, great steady stream of profits. But let's look at some of those companies. Some of them have 20 and 25-year fixed price contracts, very secure, excellent in a low inflation environment. Some of them do have inflation clauses to those contracts. Some don't. You could be earning have a company that's earning $1 billion in profit now, that in 20 years, you could say with a high degree of certainty, will also be earning $1 billion in profit, which may be a disaster from an investor's point of view if you have runaway inflation. Conversely, and I don't know anything about the company, but I'll use it as an example. Nike, maybe Nike can pass on all of its cost increases and continue to enjoy the same kind of margin in an inflationary environment on its various great products that it makes. And maybe as an investor in their stock, that's a great way to protect yourself against inflation. Real estate could be the same thing. I often point out to people all the stories of, you bought that house or that piece of property 50 years ago for $1,000. Can you believe it? This is, so much foresight. And in fact, on a purchasing power parity basis, in many of those cases, it's really the same. Has it gone up in value? Sure, in paper currency it has. But somebody earning $5,000 a year maybe bought a $10,000 house and earning 500. That same person would be earning $500,000 a year and $1 million house now. So I think there's a role for all three of those asset classes in this inflationary environment. And many of us have the opportunity or even a requirement to own the place that we live. That is hopefully an asset for many people that can protect them somewhat from inflation. But one thing about gold that's different from the stock market or from real estate is you're not really betting on any people, management team, business, technology, concept. It's a shiny metal. And it is what it is. It's got various chemical properties that have made it into what it is over the last few thousand years. And it's nothing more and nothing less. Real estate, if you're in a good location, that may really benefit you. If you're in a poor location or there's an economic downturn and you own commercial real estate, maybe you can't lease out the building, and you're actually losing money on it now. So there are pluses and minuses, obviously, to both equities and to real estate that aren't there in gold. You may be able to make a lot more money in real estate or in the stock market than gold, but the opposite is also true. The other thing I'd highlight, the asset class, or the key one that you didn't discuss or flag or float, was fixed income bonds. I think if we are subscribing to this inflation hypothesis, then you really have to consider, what do I need to have any allocation to that, where I'd have a nominal, effectively zero real return or absolute return, but your real return adjusted for inflation is almost certainly going to be negative. And those instruments have a role to play in the financial ecosystem, obviously. But if I'm an investor that does not have to, by mandate or other requirement, own fixed income instruments, and I have a time horizon where I don't need the liquidity in the next 3, 6, 9, 12 months, whatever your time frame, I would say don't own any right now. So definitely a place for real estate, definitely a place for equities, but gold is kind of the dumb keep it simple, stupid hedge against inflation. Always has been, and I think will continue to be.
Yeah, so you raised a bunch of good points, and wow, there are many areas that we can go with this, but I want to ask you a couple blocking and tackling questions, and come back to a couple of themes. Excuse me, but there's one thing we talked about, this purchase power parity. Many people miss this, and we talk about this on our show a lot, and we even look at, if you take most asset classes, especially post 2007, 2008, and you use the Fed balance sheet as a denominator, many are flat, just fundamentally flat. And so, yeah, your balance goes up, but actually in real terms, you can use kind of the Fed balance sheet as a proxy for purchase power, if you will, in the long term. Your purchase power actually stays the same. And a lot of people, like you said, I love this analogy or the story that you told about people saying, well, I bought real estate for 10,000 and now, can you believe it costs $1 million? Yeah, I can believe it. There's inflation, right? You didn't outperform any market. You got zero alpha on your real estate investment, other than you could have put it anywhere else and it would have given the same results. And I think it's very important for our audience to look at things, in context. Try to seek some sort of alpha when we're looking at investments, and understand that, when the market goes up, all of it goes up. And so while you might be more wealthy on paper in terms of nominal dollar terms, in real dollar terms, like you said about bonds, it could be at parity or negative. And so you're not really getting anything.
And the quantum of, sorry to interject, but just to take us back to the end of World War II in the United States, and the real return on bonds troughed at, anybody I say this to goes away and fact checks it, because it's just such an unbelievable number. Real returns troughed, real rates. So your real return on T-bills troughed at minus 40% a year. So when we talk about, oh my goodness, there's only $20 trillion of negative yielding debt in the world, whether it's negative 25 basis points or negative 1%, whatever it is, we'll only be able to do this accurately with the benefit of hindsight. But let's look back at what the real rate is there. It's probably something negative high single digits once you affect for inflation. Again, we'll only know the real inflation in the years to come, looking backwards. But can it get more negative? Yes. And we have relatively recent history with good data. Post World War II, U.S. debt to GDP exceeded 100%, and you had a bunch of very positive factors working, giving basically tailwinds to the effort to inflate their way out of that debt position, and it worked. But a big part of that was hugely negative real rates, and I think that all arrows are pointed at that happening again, and we're not anywhere near how low they can go. I think most people alive today would say, well, that's just totally impossible. You just can't get to net real rates of negative 40%. It happens. It's happening as we speak in various countries around the world. It has for several years, but it even happened in the United States. almost in, or, well, not for many of us, but for some of us in living memory, that did happen. And I don't see why it can't happen again. In fact, that's my base case projection.
So actually, I was going to ask you about the fixed supply of gold, but I think this is a very important point. Can you explain to the audience? So, let's actually go through a scenario. How does this happen? How do we reach negative 40% real rates? Because I think this sets up a following up discussion that we should have, but this is a part of the blocking and tackling. So negative 40% real yield is, again, something that's very hard to grok, very hard to get your mind around. How the heck does that even happen?
So it's not done by changing the policy rate. So whether the Fed rate is 25 beeps, 50 beeps, 2%, 0, at some point, that's not the main dictation, not the main factor dictating where real rates or real returns are. It's really driven by inflation. So let's say I have an effective policy rate of 0. My T-bills are sold, they're at 0 yield, but I've got 40% annual inflation. Again, it just sounds just shocking and almost laughable and the more sophisticated intellectual you are, so that's just ridiculous. But we're seeing it. Look at the price of gasoline in the United States year over year. Look at the price of various commodities. We saw the big spike in lumber prices just right across the board. You're hard pressed to find a bicycle in North America this summer. So it is possible. It has happened in the United States in the last 100 years. It is happening as we speak in other countries, and there's of course the hyperinflation examples of Venezuela, Zimbabwe, Weimar Germany, and so forth. But this to me is actually my base case now, and that's how we get that hugely negative real return, is not through policy rates or anything set by the Federal Reserve or any other central bank or institution, but really through inflation and the market dynamics of that following through to what your actual return is.
It's such a fascinating time for us. I mean, Shimon and I talk about this all the time. My base case, and this is where I kind of disagree with you, although I agree with all the premises that we're actually going to see deflation. And that's because of all the technological advancement that we have. But we have these two market forces. I almost see this as boiling water. It's kind of like whack-a-mole. The bubbles are bubbling up at different places. We had lumber spike, copper spike, bicycles, so there's these transitory effects. Some are going to stay. There are labor effects, probably not going to go away. There are supply chain effects. There is the insane money printing that we have in the QE that they're thinking about, talking about, right, and tapering, and I don't know when they're going to taper that, and all these things. It's like the market, especially this whole year, can't figure itself out. Is it inflation? Is it deflation? Is it, coming up? Is it transitory? So it's going to be fascinating. I think, like I said, years back, looking back on this to see what is actually happening, right? And how the market will settle out. But I want to bring you back to one quick thing. I want to get this out of the way, because I think it's important to understand. You said way back in the beginning, I just want to check the box and make sure I understand it. You said, hey, when we mine 1 to 2% more gold, right, per year, it doesn't really change the price. Can you just help explain that? Yes, 1 to 2% doesn't move the price in and of itself, but how hard is it to mine more gold? Is the supply actually fixed, right? We talked about the intrinsic value of gold, goes to Samsung, let's say, for chips. A lot of it is used for jewelry, depending on where you are. India obviously is a big jewelry market for gold. It can be used for as a conductor of electricity. It's a great conductor of electricity. But is it used for these things? Is there intrinsic value? How hard is it to get actually more of it? So if gold price goes up to 10,000 in real terms, are we going to see more mining come online and go out and, get more gold?
So that's a great question. And I think also brought to the forefront by Michael Saylor, one of of course, famously one of the main proponents of Bitcoin, at least for the last 6 months or so. And what he had said frequently in his musings on Bitcoin and gold versus Bitcoin is, yeah, but the amount of gold out there increases by 1 or 2% every year, but if the price doubled or tripled or quadrupled, people would find a way to produce more gold, and there would be huge profit margins in it for them. And humans are creative, and technology is always improving. I'm going to give you a pretty lengthy and detailed answer on this one, because I think it's a really a critical question. Few observations. Number one, the last cycle where we saw gold started around $250 an ounce about 20 years ago, peaked at just over $1,900. That's a huge move. So it almost octupled during a relatively short time period, and then held much of that gain. So it came down to close to 1,000 again, but for the most part, it was above 1,200. So 4 or 5x where it started. Huge change in price terms. What happened with gold miners and the production of gold? The discoveries did not increase. In fact, if you look over the last 20 years of this now much higher gold price, the amount of gold discovered, despite billions and billions of dollars being thrown at it and increasingly sophisticated and innovative technology being thrown at it, it's actually gone down. So those are hard numbers we can reflect on, and we could see that we'll probably have a few years ahead of us of actually declining gold production, no matter what happens to price right now. So that's a proof in the pudding example, where we've seen a huge increase in prices and no follow through, total inelasticity of supply. Trust me, if I could make twice as much gold, I would be making twice as much gold. Just can't do it. Second observation about that cycle is where prices were. Imagine for years you're at $250 or $300 an ounce. Well, what did your operating cost have to be as a miner? Less than that, obviously. Otherwise, you wouldn't be operating for very long, would you? Now, where is it industry-wide now today? It's about $1,000 an ounce on an all-in basis. So great margins for people with gold sitting close to $1,900. But that price is a sum of all the costs of operating a gold mine is going up and up and up and up. Obviously, when the cycle started, it wasn't $1,000 an ounce because gold was at 250. It was 150. It was 200. It was 225. So the operating cost for gold miners just totally tracks inflation as well. In fact, as you get scarcity, like in any industry, of people, of prices, of your input commodities, like remember when you're gold mining, you're very dependent on cyanide. You purchase oxygen. You're purchasing steel ball bearings. You're basically a purchaser of a lot of commodities. You're also consuming a lot of energy, whether it's diesel, electricity, if you're very lucky and on a grid, gasoline, etc. So you have these huge input costs that are also tied to inflation. So the operating cost is going up. The finding cost is going up. And one final sort of bigger picture step, 2, 3, 4, 5 steps backwards and looking at the macro on gold. And I have this great location on our near one of our mining operations in Botswana, where you can see standing in one place 1,000 years of evolution in gold mining. So 1,000 years ago, you kind of needed 100 grams per ton kind of grade, triple digit grades of visible gold, where ancient miners or medieval miners, depending on where you are, would see the gold. They would mine it. They would use chemicals, very simple chemical processes and physical processes to extract and isolate that gold. And there's an outcropping of limestone where you could see holes that were made by ancient miners using very basic chemical processes to extract gold from that 100 plus grams per day. It would have to be for them to be able to identify and extract that gold. Immediately adjacent to that limestone rock, which is 800-900 years old, that working at least, is a stamp mill from the 1800s. And this is a very arid, desert-like environment next to the Kalahari. It's like it was manufactured 10 years ago. It's standing there in perfect condition. You could read the nameplate. It was manufactured by a British company in Zimbabwe, and it was used in Botswana. And the stamp mill is basically a hammer going up and down, smashing rocks into smaller and smaller pieces. For that to work to extract gold, you need a grade of 10 grams. per ton or higher. So you've gone from 1,000 years ago, 100 grams a ton, to 10 grams a ton as your necessary for your prevailing technology of the day in 100 years ago. So took you a millennium to go down by an order of magnitude in grade because your technology's improved. Now 100 years goes by, not 1,000, 100, and you're in the year 2021. Average grade for the gold mining industry, 1 gram per ton. So if you find something now and it's a big deposit and it's 2 grams per ton, hallelujah, high fives. We're making big money. Guys are extracting gold from 0.5 grams, 0.6, 0.4. And you know what? That number is only going to go down because our technology is going to get better. But you have to, you're moving that much more rock. You have that much more technical challenge. You're throwing all this at it. And that's what we've got to work with. So the moral of that story is the costs are just going to keep going up for gold miners. So 2 things: costs are going to keep going up. They'll track inflation even with the technology. And second, we've got 1,000 years of history, and in particular the last 20, which show that the cost of production is going to track inflation. So yeah, it's good business to be in if gold's rising and inflation is the cause for it. But you're gonna see that translate through to your operating costs. So if my cost is $1,000 an ounce now and gold's at 2,000, that's great. I'm gonna enjoy $1,000 an ounce margins for a while. My cost is gonna keep going up. If I see gold at 3,000, I bet you my margin's gone up, but I bet you my cost is now 1,500, 1,600, 1,700. So it's also gonna track with it. So very subtle question you've asked there, but a critical one, and really one of the reasons why gold has performed as a store of value for so long is that property of gold is no matter what you do to the price, we can't make that much more money mining that commodity, nor can we really increase the supply of it.
So first of all, this is amazing. Conversations like this is pretty much why I wanted to start this podcast, because like many times I'll hear, people refer to something on other podcasts and they'll just like move on, without going deep. So this gives me a really good understanding. I think I totally buy the thesis of, the increase in gold supply being completely fixed. I think we have a great track record of that. And now I understand the mechanics of why. So this is fascinating. Now, let's think of another thing that Bitcoiners say, which is, okay, great. Yes, we buy that gold will never increase more than 1 point something % per year. But this is the current. So Bitcoin, right, is in many ways built to emulate gold, like even from terms like mining into like the monetary policy of Bitcoin, which like starts, it started by being very inflationary, and then like every halving cycle, the supply of Bitcoin decreases by half, which you could claim that the gold, like if you look at it in a historical perspective, is like that, right? Like the first person finding the first gold and then finding the second rock of gold, it's like, oh, you increase the supply by 100%, and then it keeps decreasing. So this is great. But like Bitcoiners will tell you, okay, but the next halving cycle, where we cut the supply by half again, suddenly it flips gold. And it's the only kind of entity or only vehicle out there that grows at a slower rate than gold. And some people basically say, oh, at that stage it will be a no-brainer if you can choose to put your money on Bitcoin or put it in gold. Bitcoin is a no-brainer because it grows more slowly. What would the investment case for gold be, let's say after the next halving? So imagine that Bitcoin grows at a slower rate than gold. Why would people still why would they consider buying gold at that stage?
So, there are so many good points that you brought up there, and I've over the last 5 years or so become really fascinated with Bitcoin, and bring it as a mathematician and computer scientist. The elegance of it is just breathtaking. It's just I just marvel at it, and there's another thing which I think maybe somewhat inadvertently, but maybe it was again phenomenal foresight by the designers, or Satoshi and friends, the designers of Bitcoin, that which I sort of stumbled across myself as I started mining Bitcoin. and only really then started to understand the real dynamics around the cost of trying to produce the marginal coin.
So you
But
do mine Bitcoin.
In fact,
Fantastic.
on a fairly large scale, I stopped in 2018, which is a story unto itself. Not because I lost faith in Bitcoin, but because I couldn't make any money doing it. There's a lot of again, it's probably worthy of a whole other podcast itself. But like any industry, once it's got a spotlight on it and there's opportunity there and scale, it professionalizes, and you really, to consistently make money on mining Bitcoin, you've got to be a scale operator with ultra low costs, outstanding execution, and really know what you're doing. And you have to be all in on that business. You can casually do it and make money, but I will tell you, you're doing it. If you made money, you did it virtually by accident, not through great planning. The way people have made money from mining Bitcoin for the most part is that Bitcoin went up a lot. It wasn't the actual margin from mining it. Once you fully cost your production, it's really the fact that Bitcoin as an asset has performed. And so in most cases, you would have been better off just buying Bitcoin. Whole different story. But one thing, going back to the question itself, is what's the case for gold and Bitcoin's finite supply, and as we approach the terminus, how does that change the investment case? I'll take us off on another slight tangent. The cost of producing the marginal coin of Bitcoin, like gold, but algorithmically so, is very sticky downwards. So as the price of Bitcoin moves up and more people join the network, there's more capacity on the network. It's more competitive. You need to throw more computing power at it, consume more electricity, and so your operating cost goes up. So you get this nice, just like gold, you get this nice sprint and surge in margin when you have a nice sprint in the underlying price. But as the networks, people jump on and say, yeah, I'll have some of that, please. Your operating cost goes up and your margin goes literally to zero. We've seen it several times on Bitcoin. And then the price comes down. And you have a whole bunch of marginal miners here, casual miners, who figure out, wait a minute, I'm losing money. And that a little bit of capacity comes off the network, but your core capacity stays on. So that operating cost never really comes down that much. So that's a sort of a built-in force to help keep the price of Bitcoin higher, which was one of the earlier observations for me. I was like, this thing is almost designed to go up. It's becoming less and less of a factor because the marginal mined Bitcoin is less and less of an impact on the total supply, for obvious reasons. But looking back 5 years ago, that was more of an effect, where if you had almost this built-in escalation in the cost of producing a marginal coin, it's a built-in limiter on how those coins can come to market. You needed a higher Bitcoin price to make that happen. And once it's gone up, it may come down for a while, but it's almost algorithmically levitated unless people completely exit the asset class and the fund of flows start to reverse. So after taking on those two tangents that nobody asked for, I'll come back to the original question, which is, what's the case for gold then? And I think this is the big question, right? Is gold really still the store of value, or is it almost completely worthless? Because if it's not a store of value, yeah, we'll use 1% of the gold that's produced on an annual basis for semiconductors and high performance applications. But guess what? We got 100 years worth of supply for those applications already above ground gold. So if it's not held as a reserve asset or as a store of value by central banks and on people's wrists and around their necks as jewelry or in their safety deposit boxes, that is not a relevant amount of demand to offset that. So if it is not a store of value, it's worth almost nothing compared to its current value. The other side is, what if Bitcoin is not a store of value? Either it is a store of value and it's something that is becomes a primary reserve asset, which is not, I think you can say, is not unthinkable now. It is possible. In which case it could be worth a lot more. And if you look at, I gave an interview in 2018 I think it was towards the end of 2018, and Bitcoin was 10,000 or less at that point. It certainly come off its highs, and I gave a target of $100,000 on Bitcoin, but with lots of caveats. And the caveats were, if it becomes a true store of value, it should actually be a lot higher than 100,000. But if it's not, it may actually be worth almost nothing. And why is that the case? There's better cryptocurrencies out there for accomplishing other specific tasks. Nobody has the kind of network that Bitcoin does. There's currently a network value there, but in 100 days, people could the capacity can switch over. The infrastructure stays the same. Maybe the chips change, but those are very 18-month life or less anyways. The world can move on surprisingly fast. If for some reason we decide Bitcoin's not a store of value, there are other very interesting cryptocurrencies out there. So I think it comes down to this question: is gold a store of value, the only real store of value in the world going forward? Is it not a store of value at all? Is it somewhere in between, i.e. it's still a store of value, but there's room for other things like Bitcoin? And then to your question about what's the case for gold after the next halving on Bitcoin, you also have to ask the question, what's the case for Bitcoin? So if Bitcoin is really becoming a primary reserve asset, you can come up with values that are much higher than $100,000 for Bitcoin. But if it's not, where's the floor? Like, what's the underlying value on it? So there's a big question to answer here, and it's all about what's really a store of value, what's going to drive that, and what role do each of these assets play in that. And to me, I come back to two rather simple observations, which let me be honest, guys, I'm not 100% convinced of, but they're what I have to work with, so I'll share them with you. Number one is central banks own a lot of gold, and many of them are continuing to buy it for the last 10 plus years, since 2008, which they hadn't done for a long time before that, which is curious. If it's the pet rock and everyone's dismissive of it, why did they keep holding it? Literally trillions of dollars of gold, and keep buying more. They own functionally no cryptocurrencies. They may be issuing their own cryptocurrencies in the near future, but they don't have trillions of dollars or billions of dollars. There isn't trillions of dollars of Bitcoin yet, but they don't have billions of dollars of Bitcoin, probably. We don't know that totally for sure. And so that's one observation. They happen to have trillions of dollars of gold. So if central banks have any say still in what's a reserve asset and a store of value, presumably their minds are wrapped around what they have $1 trillion+ of. And the second one is and I would probably raise the hackles of a lot of Bitcoiners. Is Bitcoin is very, some of the things that it's very good at, and this applies to many cryptocurrencies, are things that governments just do not like and are very problematic. They haven't really taken too much exception to it, because I think it's been a rather mild problem, and I think for the most part, things like criminal activity are grossly overblown and totally a red herring. But evading capital controls and your ability to move your money around the world, it's so good for that. It's phenomenal. It's amazing. And there are going to be more improvements on that in time to come. Also, if I use a reductio ad absurdum type argument, if we start transacting primarily in Bitcoin, it becomes, there are ways then to avoid huge amounts of tax and really create an even larger black market economy. And if I flip the switch on the cryptocurrency argument and say, if I'm a central banker or if I'm a treasury department, I'd say, what would be really great is if I actually completely got rid of cash and got everybody using a cryptocurrency with a blockchain and permanent record of every transaction ever that I still control. And obviously that's something we're seeing coming down the pipes. So I think if you're a cryptocurrency investor, you can't ignore the fact that many of the reasons why we like these things so much are reasons to be worried about them, because there is no argument against it. They are very good for some of these applications, and those are sort of libertarian. I won't use the word anarchist, but definitely very libertarian type values and properties of it that are contradictory to the interests of many levels of government. And so I think you've got a built-in on two fronts. It's sort of the starting point is gold, because they happen to have a lot of gold, and it's always been gold, and so you're caught that way. And one argument against that is, well, we always bought books from bookstores, and we stopped doing that at some point. And so things do change. So you can't be completely married to that argument. And then on the second side, the fear that governments have at just how good cryptocurrencies are at what they were created to accomplish. They're effective and becoming even more so. So those factors to me keep pushing me back to, if I had to pick one horse, my preference is to have both horses, by the way. But if I had to pick one, I'm going to stick with gold for those two primary reasons, which, as I preface this whole monologue, I don't have 100% confidence of even myself, but that's what I have to work with, and that's the basis of my argument.
So I just wanted to recap this for our listeners, because I think I've never heard this argument anywhere else on other podcasts, and it's very convincing to me. You're basically saying, look, Bitcoin will have a lower increase rate every year, which theoretically could make it a better store of value than gold. But on the downside, governments already hold gold. And if they had to pick their poison, they would much rather back gold. And so they could attack Bitcoin by, for example, setting special taxes on it and exempting gold from tax. They can do different things to just steer the store of value function towards gold, because they own it. Really good argument. I know Alex wants to ask you a question.
Or steer it towards their own cryptocurrencies.
I don't think their own cryptocurrencies. I think that's a complete red herring, because their own cryptocurrencies will be inflated at the rate of the monetary supply. So I just completely ignore that. It's just hype, I think. But you make a very good point that they do hold gold currently. So, if they had to choose, do we support Bitcoin or do we support gold? They would much rather support gold.
Yeah, I think there's definitely going to be a fight when the governments are going to come in. I think probably at around 500,000, 400,000 of value when Bitcoin hits the market cap of gold. I think there's going to be a serious battle. And I think, Ravi, you're a good company. Ray Dalio says the same thing. I mean, he was a skeptic, became a Bitcoin bull, and he says Bitcoin's greatest weakness is its success. Because the bigger it gets, governments are going to come after it. I think there are many theses. I know we should wrap, but maybe we can have you on again, because it would be great to have this discussion. But there's a thesis to, when governments issue their own CBDC, central bank, digital currencies, it's almost an on-ramp into this whole world. And even if governments, let's say all of the governments ban Bitcoin, first of all, I don't think that's ever going to happen, because there's too much of a prisoner's dilemma for one country to come out and say, you know what, we'll actually support Bitcoin. El Salvador, that just, El Salvador came out and now is using as a legal tender. So all you have to do is VPN in. And there's a lot of FUD, like you said, about illicit activity, a lot of FUD about China, for example, but China banned Google and Facebook, and they're doing quite well, right? So they're doing pretty well. So and they're banning miners. Let the miners come and use renewables in North America and so on. But it's definitely an interesting argument to say, well, look, we already have gold, so we're going to double down on that. We don't want to lose what we have. And not only are we losing from a central bank government perspective, not only are we losing capital controls, we are also losing our store of value, because they do hold, gold, like you said, as a store of value. They hold a lot of gold. So I think there's always this Bitcoin versus gold, and both Shimon and I are very tech forward, and we come out of tech. And so we believe technology disrupts. Like you said, we used to sell books. Now we have Kindles, but we still sell books, right? And so the biggest argument, the most convincing argument to me, about why gold still has a place. And I really do believe that gold won't be completely disrupted. It will still have a place. Excuse me, is that central banks already have a store of gold and they won't want to get rid of that, right? This value going to zero just won't happen, which I know some Bitcoiners, the very kind of maxi crypto anarchist Bitcoiners want that to happen. Bitcoin will take over the dollar, it'll take over gold. I don't think that's going to happen, but I do believe there's a place for both, right? And I do believe as we become more and more, this is in a way long term, but to Elon's vision of interplanetary species, whether that happens in 50, 100, 200, or 500 years, who knows when, but we will need one store of value that is very fungible, very transportable, and no government can control that, because we will be a planetary species, right? We're no longer going to be a country species. Do you believe that gold and Bitcoin can coexist? Do you believe they can coexist in general? And can they coexist in a portfolio?
I think the answer from my standpoint is yes to all of those. And whenever I discuss Bitcoin, I do back away slightly and say, it could be something else too. It could be another cryptocurrency. It could be one that's out there, or it could be one that's yet to develop.
Hardcore finance coin, by the way, everyone go buy that.
Can't wait.
I'm totally kidding. Totally kidding.
You need a shorter name, and maybe throw an animal in there too. But yeah, so I don't, to me, I think, I've spent just an enormous amount of time debating with myself, just arguing with myself in my own head over Bitcoin. And I'll say, like, on one hand, you have this huge value to the network. So you got more people on whether you're actually transacting or buying sandwiches or coffees with Bitcoin, I don't think that's relevant. And that's a misnomer to say that there's no use case. If it's a store of value, I've never spent gold to go buy a pizza or a cup of coffee. So that doesn't undermine its argument as a store of value. But you have this huge value, the network effect in play here. And I dumb it down for myself by saying, well, what's WhatsApp? WhatsApp is, there's nothing that can't be reproduced there technologically. In fact, there were some other competitors that were very good, or even better, I would argue, than WhatsApp. But 1 billion plus people use WhatsApp, therefore WhatsApp is valuable. It's a network effect, and Bitcoin's no different. But on the other hand, my argument from earlier, I still keeps popping up in the back of my head, saying we can also adopt new cryptocurrencies. And in the short term, that probably creates a lot of confusion for people trying to wrap their head around it for the first time, or even like me, who've been noodling on this for half a decade, and distraction and noise. And we've seen that with just with Mr. Musk's tweets and confusing posts at times, causing huge moves in various coins for no real fundamental reason. It just really more creating confusion than anything else. So I would say room for gold, room for Bitcoin with the store of value argument, and room for potentially other cryptocurrencies that have other functional roles, have maybe interesting speculative roles. There's, we say it's a speculative asset or it's a bubble or something like that, but assets go up and down in value, and there's nothing wrong with buying one because you think it might go up, and maybe it does go up. So there's a role for that in your portfolio too, for some of us. So I like to put cryptocurrencies into two buckets. One is Bitcoin and potential other stores of value, and number two is other potentially useful cryptocurrencies where I might make money on them, or they may serve some sort of very specific use in the future and may appreciate in value as a result, or just for that reason be an important part of a portfolio. So again, I'm giving a complicated answer to a simple question. My answer is yes to all. There's room for all those assets. There is room for Bitcoin or another cryptocurrency store of value to coexist with gold. And I think I add the additional bucket, which is there's other interesting investments for a variety of reasons in other cryptocurrencies and other parts of the ecosystem as well. Maybe miners, maybe guys doing interesting DeFi stuff in around that ecosystem. There's, we could go on for hours about the other opportunities, and most of them haven't even been thought of or implemented yet.
Yeah, I mean, I just wanted to say that this is maybe the first time where I disagree with you, but I just want to share it with our listeners. I really think that in the store of value category of cryptocurrencies, I don't think any other cryptocurrency has even a chance of competing with Bitcoin. And I'll tell you why. So yesterday I had a surreal experience. So I was in Twitter Spaces talking about, there was a friend of mine started like a Twitter space talking about El Salvador and the bill. Suddenly we see the brother of the president joining the Twitter Spaces. And he's like, hey, yeah, I'm the brother of president. I'm like, his campaign manager. And I saw this on Twitter, so I decided to join. And then more and more people started entering the room. At some point, the coalition stopped like their speeches and the opposition started. And he was like giving us live updates from the bill that was being voted on. He's like, oh, the opposition now is speaking, and we have something like a filibuster only. It can only last like 40 minutes because like they only get like 5 minutes each or something. So in the meantime, let's see if my brother can join. Suddenly, the president of El Salvador joins our Twitter space and starts like talking to us and starts talking about Bitcoin and how, he really believes in it and so forth. Now, look, El Salvador doesn't have, they're dollarized. They use the dollar as their currency. So they're not giving up a monetary policy, but it was surreal, and he had a lot of insights actually about Bitcoin. His knowledge was pretty deep. And then at some point somebody said, hey, you have geothermal energy in your country. Like, why don't you use it for mining Bitcoin? He's like, oh my God, I never thought of that. That's great. And then now today he tweeted that he is instructing the geothermal electricity plants to mine Bitcoin and stuff. And it's just surreal, the time we're living in. But I just wanted to say, El Salvador would never choose a different cryptocurrency as their own legal tender, because there's no other cryptocurrency that's not controlled by a few people, right? So like Bitcoin is really the only one that is decentralized enough so you could actually put a meaningful amount of money in it without being afraid that someone can confiscate it, not by hacking the protocol, but just by taking 10 people, putting them in jail and saying, unless you change it, you're not getting out. So I really don't think that store of value can be done in the crypto space by another.
I think you have a point there, and it goes to my point of like, why is WhatsApp valuable? Is because a billion people use it, and Bitcoin has that network effect working for it, and sort of an order of magnitude beyond anything else out there right now. The only thought bubble I'll leave you with on that argument is, I would have said the same thing about Skype a few years ago. We all used Skype and it was great, and now I never use Skype. So I don't know how many people use Skype at its peak, but it was a lot. The other conclusion is, is wrecked because Microsoft bought it, but whatever. There are other examples of things that were, unthinkable. And then, that's never going to change. And then something else came along. I can't imagine something completely supplanting or displacing WhatsApp. But you know what? I bet something will at some point. I don't know what it is. I have no idea why, but something will at some point. And I think just as gold is at risk of a complete disruption and paradigm shift, I think you also have to consider any particular coin. There could be something else that comes along which takes the best of it. And maybe in the case of Bitcoin, it's one that's takes all the great things about Bitcoin and somehow does it more efficiently from an energy point of view, or somehow bridges the gap with the angst that'll ultimately, if it's trading at $1 million a coin or several $100,000 a coin, the angst it'll cause for governments. I don't know, but it's something that's possible in the indeterminate future. And maybe even if it does happen, Bitcoin's at 5 million a coin by then. I don't know, but it's certainly in the realm of the possible.
Ravi, I just want to say something quick, and I know we'll wrap, and Shimo will wrap. But we've talked to other gold folks before, and I just want to give you an immense amount of credit and a shout out, because, and maybe it's because you're a mathematician by trade, and you've gone deep and studied Bitcoin. we're both, pro Bitcoin. Again, we're both technologists, but this interview was the most balanced, logical perspective on both, with arguments, and we can disagree around the edges. I think we agree overall around 90% of what we discussed, right? Sound monetary policy, store value, network effects, and so on. But a shout out to you for having a very balanced, sane, if you will, logical approach to both, where you have others, especially some of the more memeified people like Peter Schiff in the industry, that are just, gold. It becomes noise. It becomes noise. And it's not about gold or Bitcoin. Bitcoiners have the same thing in their end. But there is, I think, something to be said to having a nuanced view of both. And especially for our listeners who are looking at their portfolios, I think a lot of people are thinking about, there's either inflation or deflation coming down. How do I protect my wealth? Where do I invest? If I'm invested in S&P, but really in purchasing power terms that stayed pretty flat since 2008, right? If you just look at the monetary printing that we've had, what do I do if this big rush of pain comes? And I think having a very sane approach is saying, look, there's a place for both. Here are the pros, here are the cons. Do your own research, listener, so to speak. We never offer fully financial advice, but we're here to bring information. So anyway, kudos to you. And thank you for a very balanced, smart approach to both.
Look, this has been a great discussion. I really enjoyed some very on point questions and topics you guys both raised. So it was fantastic. I'd love to continue the conversation sometime.
Yeah, Ravi, would love to have you back on. So yeah, please tell our listeners, where can they find about you and your work online?
Yeah, just look, I'm pretty visible. If you could LinkedIn, and I'm not otherwise active on social media, but as you mentioned in the preface or the intro, I'm the chairman of Galane Gold. It's a public company itself, symbol GG, and on the Toronto Stock Exchange, and also the chairman and co-founder of Jade Power Trust, which is also a public company and a renewable energy producer. So we operate wind, solar, and hydro facilities. It was actually with that company where I started mining Bitcoin, trying to do it with 100% renewable energy, and learned a lot. Let's say the hard way of trying to make money. Doing it obviously with a pure profit intention, and did initially make a bit of money, but much like my experience in the gold business, I got in earnest with the Bitcoin close to 20,000, and watched it go down by 3/4 by the time it reversed direction, and learned some painful lessons that way, but also really started to understand the guts of how it works in a way that I just, even with my background as a mathematician and computer scientist, had not bothered to try to understand previously. It was that was really what opened my eyes to the potential of Bitcoin. Let's say also the threat of it. So I'm still very much in the gold camp, and if you put a gun to my head, that's the horse I'm riding out into the sunset on. But I haven't changed my view that there's a role for Bitcoin and again, other cryptocurrencies for varying reasons in one's portfolio.
Awesome. Well, thank you so much again for coming on the show. This was a great discussion, and looking forward to having you again at some point.
Thank you very much.
Thanks, Ravi.